Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Sensient.
If you find our talks useful, please consider subscribe, like, and comment underneath. And just a quick note before we jump in, we do have a link to the StockOracle 14-day trial down in the description. It is an affiliate link, so we get a small commission if you use it. But please remember, AI insights and value estimates can sometimes be wrong, so you should always verify the data yourself.
Cool.
We are just sharing our research today. None of this is financial advice.
Right, exactly. Always do your own due diligence. And today we are heavily focused on long-term wealth building, looking past the short-term trading noise. And Sensient is just, well, it's a fascinating case study for that.
It really is. I mean, we're looking at a business that is basically acting as a massive bottleneck for the entire global food and beverage industry right now. Our mission today is to dig into their Q2 2026 earnings, the SEC filings, some recent analyst notes, and figure out if their valuation makes any sense.
Yeah, because there is a serious tension in these documents. We have this explosive, legally mandated demand on one side, and then on the other, a balance sheet that shows the massive hidden costs of trying to meet that demand.
Right. So whether you are trying to find durable growth for your portfolio or you're just fascinated by how obscure regulatory deadlines completely rewire the supply chain of the food in your pantry, this deep dive is going to break it all down.
Absolutely. And I think the best place to start is the immediate catalyst, right? The thing that put Sensient on everyone's radar recently is that Q2 2026 earnings report from early August.
Yeah, August 4th. And the market reaction wasn't just positive. It was a violent repricing.
It really was. The top line numbers were fantastic. They reported Q2 revenue of $462.1 million.
Yeah.
That's up 11.6% year over year.
Which is solid.
Yeah.
And then earnings per share came in at $1.20, completely crushing expectations.
Right. But the real kicker was management raising their full-year EPS guidance. They bumped it up to a range of $4.10 to $4.20.
Which, in this macroeconomic environment, raising guidance is, well, it's a massive flex.
Exactly. It's the ultimate signal of management visibility. They are basically telling the street, hey, we aren't just having one lucky quarter. We have the contracts locked in that guarantee the rest of the year.
And the market bought that narrative entirely. I mean, the stock surged over 45% over the last 26 weeks. It's sitting around $134.56 right now.
Yeah, which is just 1.5% below its 52-week high.
Right, but, and this is where I put on my cautious capital protection hat, that surge brings us to the elephant in the room, the valuation. Sensient is trading at a PE multiple of 35.3.
It's steep. I won't deny that.
It's incredibly steep. I mean, paying 35 times earnings for what is essentially an ingredient supplier. That feels like buying a house in a gentrifying neighborhood after the prices have already doubled. Every bit of good news, every optimized factory, it just feels utterly baked into that price.
I get that. A multiple in the mid-30s demands absolute perfection.
Exactly. There's literally no room for them to stumble. A delayed shipment or, a tiny margin compression, and the stock could correct violently. Where is the margin of safety for a long-term investor?
Well, the margin of safety comes from the quality and the durability of the growth. If you look at the underlying data, the market is paying that premium because of the structural nature of this revenue. Their trailing 12-month revenue growth is 8.12%.
Okay, so it's consistent.
Highly consistent.
Yeah.
This isn't a sudden spike because one specific sports drink went viral on social media. It's sustained compounding acceleration. The market is betting that the baseline demand for Sensient's existing and emerging engines has fundamentally shifted upward.
And we need to explain why that demand is shifting, because it's not consumer whims driving this, it's the law.
Right. The medium-term catalyst here, the massive driver, is a hard regulatory deadline in January 2028.
Right. The government is mandating a total transition from synthetic food colors to natural colors.
Yes. And to understand why this creates such a massive economic moat for Sensient, we have to look at the chemistry.
Let's unpack that, because on the surface you'd think, okay, just swap the red dye for beet juice. What's the big deal?
Oh, it is a huge deal.
Yeah.
For decades, the existing engine of this industry relied on synthetic dyes, things like red 40 or yellow 5. These are essentially petroleum derivatives.
Which means they're dirt cheap and basically indestructible.
Exactly. You can boil a synthetic dye, you can freeze it, blast it with UV light, put it in a highly acidic soda, and it remains perfectly stable. It's always neon red. But natural colors, They are derived from living organic compounds like anthocyanins in cabbage or curcumin in turmeric
Right, and organic compounds degrade.
rapidly. If you put a beverage colored with natural beet juice on a supermarket shelf near a window, the UV light breaks down those organic molecules.
So your bright red strawberry drink turns into, what, a murky brown?
Yeah, in a matter of days.
Hmm.
And it's highly sensitive to pH levels, too. A natural red dye might look beautiful in water, but the second you add it to an acidic citrus beverage,
It reacts?
it can spontaneously turn blue or even precipitate entirely and leave this weird, chunky sediment at the bottom of the bottle.
Oh, wow, yeah. No major consumer brand is going to risk that.
Which is why a brand can't just swap the dye. The entire formulation of the product has to be completely re-engineered to stabilize that new natural color.
And this is where Sensient's emerging engine comes in. This is their moat.
Exactly. They aren't just selling vegetable juice. They have spent years building proprietary encapsulation technology, advanced extraction methods that protect those fragile organic compounds from heat and light and acidity.
So when a massive, multi-billion-dollar food conglomerate faces this hard 2028 deadline, they don't have the time or the internal R&D to invent stabilization tech from scratch.
They don't. The shelf life testing alone takes years. So they call Sensient. Sensient isn't just selling ingredients, they are selling regulatory compliance and brand protection.
I mean, it's pretty rare to find a business where regulators literally force your customers to buy your premium product. The government has basically created a hypergrowth cycle out of thin air.
And it turns Sensient into the most critical, highly leveraged bottleneck in the global food industry. These brands have to buy Sensient's compliance solutions right now, today, to ensure their supply chains are tested before January 2028.
So it's a massive demand vacuum, pulling years of future revenue into the present, which explains the pricing power.
Oh, the pricing power is incredible. Let's look at what this is doing to their margins, because the profit expansion is vastly outpacing the top-line growth.
Yeah, the margin story is where that 35 PE starts to actually look a little more rational. In the first half of 2026, revenue grew 11.3%, but net income skyrocketed by 32.6%, hitting $95.5 million.
That is the textbook definition of operating leverage.
Right. Their trailing 12-month gross margin is a very healthy 34.88%, and the net margin is over 9%. They are getting so much more profitable with every new dollar of sales.
Because they are completely changing their product mix. When you move away from cheap synthetic dyes that compete on fractions of a penny, and you shift your customers toward highly complex proprietary natural solutions.
You stop competing on price.
Entirely. You compete on value and risk mitigation. If you are saving a global brand from having their entire product line pulled off the shelves, they are not going to haggle over a 10% premium on the coloring agent.
Makes total sense. It's a permanent upgrade to their business model.
It is. Premium natural formulations just have a much higher floor for gross margins. And as that 2028 deadline approaches, a huge percentage of their total volume shifts into this premium category.
Okay, so I hear all that. Top line growth, expanding margins, massive moat, regulatory tailwind. It sounds like a wealth-building machine. But if we peel back the SEC filings, there is a glaring contradiction on the balance sheet that honestly threatens this whole bullish thesis.
It's a cash burn.
The cash burn. I mean, the income statement shows massive profitability, right? $95.5 million in net income. But the cash flow statement tells a very different story.
Yeah, we have to separate accounting profit from the actual physical cash moving through the business.
Let's break down the reality. Despite the record earnings, Sensient's operating cash flow actually dropped in the first half of 2026. It fell to just $34.8 million.
While at the same time, their capital expenditure exploded.
Right. CapEx increased by 78% year over year, up to $67.5 million. So if you subtract that CapEx from the operating cash flow, you get a negative free cash flow proxy of minus $32.6 million.
They're burning cash while reporting record profits.
Exactly. And the balance sheet shows the toll this is taking. Long-term debt has climbed to $763.5 million, while actual cash on hand is down to a very thin $31 million.
It's a heavy debt load, no question.
And as a quick side note, the sources flagged that a company director sold about $155,000 in stock in early August.
Which is a small amount, relatively speaking.
It is small, but when you combine insider selling with a depleting cash pile and rising debt, it's a caution flag for anyone focused on capital protection. Where is all this cash actually going? Because you don't increase CapEx by 78% just to fix old machines.
No, you don't. And this is the crux of the bear case versus the bull case. Sensient is in a massive, aggressive investment phase. They're frantically building the physical infrastructure, the specialized extraction plants, the clean rooms, to handle this impending 2028 natural color wave.
So they're building the factories before the orders officially arrive.
They have to. You cannot capture a regulatory gold rush if you don't have the physical capacity to process the raw materials. The encapsulation tech requires incredibly expensive manufacturing footprints.
But the danger there is the timing, right? They are paying construction crews and buying industrial equipment today using borrowed cash. But those new facilities won't generate a single dollar of revenue until they're fully online and shipping product.
And that gap, the gap between spending the cash and generating the return, is the most vulnerable period for this company.
Right, because if a macro shock hits, or imagine if regulators just randomly decide to delay the 2028 deadline by 2 years.
That would be devastating. Sensient would be sitting on $763 million in debt, burning cash, with a bunch of empty, expensive factories.
And that is exactly how a 35 PE multiple collapses overnight.
It is. But the market and the analysts are currently giving them the benefit of the doubt. They assume this heavy investment phase is going to transition seamlessly into a cash printing phase.
Which brings us to the 3 to 5 year blue sky scenario. And we should clearly state, a blue sky scenario is an optimistic condition. It's not a prediction or a guarantee.
Right. But it's what Wall Street is modeling. Analyst sentiment is highly bullish right now. UBS recently raised their price target to $155, and Baird raised theirs to $140.
Because they see the capacity utilization tipping point coming.
Exactly. Capacity utilization is the invisible metric that dictates profitability in manufacturing. Think about it. If Sensient builds a $50 million extraction facility, the fixed costs, the mortgage, the property taxes, the core staff, the KEF, they remain exactly the same, whether that factory is running at 20% capacity or 90% capacity.
Right, so if it's only running at 40%, it's bleeding money because revenue doesn't cover the fixed costs.
But once utilization crosses a certain threshold, say 75 or 80%, every additional unit produced is almost pure profit. The fixed costs are already paid.
So in this blue sky scenario, the 2028 deadline forces massive volume through these newly built factories. The utilization rates just spike.
And that massive $67.5 million in CapEx, it normalizes. It drops back down to standard maintenance levels.
Meaning the huge net income we are seeing on the income statement finally translates directly into massive free cash flow.
Yes. In the blue sky case, Sensient takes that geyser of free cash flow, aggressively pays down the debt, and cements an untouchable competitive position. They would essentially have the most advanced, fully operational natural color infrastructure in the world.
And they could leverage that optionality to dominate the entire global premium market for years to come. The business naturally deleverages, and the premium valuation is totally justified by the cash generation.
That transition from footprint expansion to capacity utilization is the single most critical trigger to watch.
Absolutely. If you are an investor looking at this for long-term wealth building, you can't just stare at top-line revenue growth anymore.
No, you need to laser focus on the operating cash flow and the upcoming Q3 and Q4 earnings releases. You are waiting for the moment those lines cross.
Right, because if CapEx stays historically high and operating cash flow remains depressed through the end of the year, that debt burden becomes a massive threat. The runway could run out before the factories are fully humming.
Exactly. A company priced for perfection really does have to deliver perfection.
Okay, so let's synthesize everything into our wealth building verdict. Based on the sources, Sensient earns a bullish overall rating in 7.
Which feels fair. The underlying existing and emerging engines are incredibly robust. They have confirmed earnings momentum, expanding gross margins, immense pricing power, and an undeniable regulatory tailwind.
The economic moat is incredibly deep. But the rating carries a massive caveat regarding execution. To justify that multiple, they have to prove that this cash drain was just a temporary bridge to a permanently expanded, highly profitable infrastructure.
Protect your capital by verifying that the cash flow actually stabilizes.
Exactly. And before we wrap up today's deep dive, I want to leave you with one final kind of provocative thought that wasn't directly addressed in the standard analyst models, but it's buried in the mechanics of this catalyst.
Oh, I know where you're going with this. The demand vacuum.
Yes, the demand vacuum. We know the January 2028 deadline is forcing the entire industry to upgrade their supply chains right now. Sensient is experiencing years of future growth condensed into a chaotic, 24-month window.
Right.
But for your own exploration, look past the deadline. Consider what happens in 2029. Once every major food and beverage brand has successfully reformulated and the regulatory mandate is totally satisfied, what happens next?
Does Sensient face a massive demand cliff?
Exactly. Once the industry is fully compliant, does the hypergrowth just suddenly evaporate, leaving Sensient with these massive expensive factories and stagnant demand? Or does their R&D pipeline find an entirely new regulatory puzzle to solve, maybe in cosmetics or pharmaceuticals, to keep the engine running?
The transition to natural colors is guaranteed, but what happens the day after the deadline passes is a complete mystery.
And that's something you will have to track on your own.
Well said.
All right, if you found this deep dive helpful, please remember to subscribe, like, and comment below. And don't forget to check out the StockOracle 14-day trial link in the description. Again, that is an affiliate link, and please always verify AI estimates independently. Thanks for joining us on Smart Wealth with Joshua. We will see you next time.